Today we're going to talk about how you can use 3 alternatives to basic candlesticks to improve your trading. Simply changing our chart type can give us an entirely new view of the market and help us better identify trends and reversals while filtering out unwanted noise. Basic candlesticks can be volatile and messy to trade and not show us clean structure and price. These powerful alternatives can help combat the shortcomings of the familiar basic candlesticks. We're going to be using some of the chart types available in TradingView. If you don't have TradingView, you can sign up for free with the link in the description. To start off, we have one of the more popular chart types. You might have heard of these before. These are Heikin Ashi candles. These candles can filter noise and identify trends. Without adding any indicator or moving average to our chart, we have a smoother version of the market to work with. These are the most similar alternative we have to regular candlesticks. Like regular candlesticks, they have a wick and are based on time intervals. They are formed linearly with time. If your chart is set to 1 minute, a candle will form for every minute, just like regular candlesticks. The other chart types we are going to go over don't behave like this, so it's important to understand the distinction. Heikin Ashi candles take the average of the open, high, low, and close of every new candle, and the open is formed at the midpoint of the previous candle. This average version of the candles can more clearly show trends, and you will see much more successive green or red bars compared to regular candlesticks. You can tell how strong a trend is by looking at the wicks of the candles. A lot of large wicks pointing upwards indicate a stronger uptrend, while a lot of large wicks pointing downward indicates a stronger downtrend. If we see small wicks pointing in various directions, there is more indecision in the market and strong directional movement is not present. Pairing Heikin Ashi candles with a trend indicator can also be a good option. If you notice the indicator you're using is having trouble filtering out small noise and inconsistencies in the market, changing to Heikin Ashi candles can help fix this. One important note is these candles are not showing the exact closing and opening prices. Since they take the average of the candle and open at the midpoint of the previous candle, we do not see the exact price it closes or opens at like a regular candle shows. The next chart type we have is significantly different than the regular candles and even Heikin Ashi candles. This is the line break chart. As you can see, we no longer have candles on the chart anymore. In fact, this chart type does not even have evenly spaced time intervals for each bar. The line break chart is based on the movements of price rather than time. This may sound complicated or unintuitive at first, but it actually makes a lot of sense once you understand it. Why would we even want to use a chart based on the movement of price rather than a set time interval? Let's think about it in terms of the significance of a price movement. If we let price movement determine whether we create a new bar, we are able to filter out unimportant price movement. Chart types that use price movement instead of a set time interval can filter out small, unimportant movements and give us more consistency in the chart. For a movement to be important enough to create a new line on the chart, it has to meet certain requirements. In a regular candlestick chart, a new candle is printed every set time interval no matter how insignificant the price movement is. Back to the line chart specifically, we have a setting that we need to understand to be able to use it effectively. This is the number of line setting you find in the chart settings. But what are line breaks in the first place? We need to know this to understand what this setting means. But it's actually very simple. Let's say we have our line break setting set to 2. To go from a red bar to a green bar, the price must break above the high of the last 2 previous bars. You can think of each previous bar as having a line on top of it. So for a reversal to happen and a green bar to appear, the price must break above the number of lines you have specified in the number of lines setting. To go from a green bar to a red bar, it's the same, except now every green bar has a line on the bottom of it, and to get a reversal to a red bar, it has to break the number of lines we have specified for it. Now we can use this information to understand why the number of line setting would affect the chart. It simply changes how many lines need to be broken for a reversal in color and direction to occur. More lines means it's more difficult for price to reverse and a larger movement is needed. Less lines means the price is more sensitive to reversals and we will capture more price movement. Setting it to 2 or 3 will show us more short-term price fluctuations and will change directions more frequently. Adding more lines can consistently capture large trends over a long period of time, since it takes a lot of movement for the chart to reverse direction. Keep in mind, the more lines you add, the less the chart moves on a day-to-day basis. This is basically the equivalent of increasing the time frame on regular candlesticks. Basically, the line break chart continues drawing a line in the same direction as price continues moving in that direction. For the chart to change direction, it has to meet a threshold determined by the number of lines we set. If the price is not moving in one direction and no reversals in price meet our threshold, nothing happens and no new bars are printed. If you're thinking of other ways we could take advantage of using only price movement to create a chart, you're on the right track. Our next chart type does just that. This is a Renko chart. The first thing you'll notice is how consistently it's structured. It only moves in 45-degree angles up and down and is made up of bricks which are all the same size. The reversals are sharp, and you'll notice a lot of continuous movements in the same direction made up of the same color brick. Each brick in the chart means the price moved by a certain amount. Think of a box above and below the previous brick that has to fill up before a new brick is created. On TradingView, the size of these bricks is set automatically by the ATR setting. You can change the length of the ATR to change the lookback for the automatic brick size selection. If you want to capture smaller movements, lower the ATR length. Although this chart type works on price movement rather than time intervals, you'll notice we can still change the time frame, and when we do that, it affects the chart. This is because it's using the close prices for whatever time frame you have set to create the new bricks. It still moves based on price movement, but if we have it set to 1 minute, it uses 1 minute closes. Changing the time frame for Renko bricks is basically the same effect as increasing the time frame for candlesticks. There are less bricks in a given window and less movement during a day. You can lower the time frame until whatever security you're trading is moving at a rate that works for your trading style. If you are doing intraday trading and notice not enough price movement is being captured to trade, try lowering the time frame. You can also lower the ATR length like I mentioned before to capture more price movement. All these chart types will still work with your indicators and can display interesting behavior. The RSI-H, which I covered in a previous video, seems to work particularly well for Renko charts. It captures the reversals in price very smoothly. I'll link the RSI-H video in the description if you haven't seen it already. If you're interested in more advanced indicators, check out the Quantifica Patreon, where you get access to the entire library of all current and future premium Quantifica indicators, link in the description. If you found this video useful, a like would be greatly appreciated. If you want to see more videos like this, go ahead and subscribe. Thanks for watching.